The G20 Summit is unlikely to produce a declaration, but it could still yield tangible outcomes. That's according to International Relations and Cooperations Minister Ronald Lamola, who says the meeting's likely to end with a chair's summary. Lamola says even if the US doesn't agree and there's no declaration from the G20 Leaders Summit, South Africa believes there's enough consensus for President Ramaphosa to deliver a substantive chairperson statement. Expected outcomes include lower global interest rates, reduced debt burdens for developing nations, and a joint program on early childhood development. Government plans to revive its mothballed pebble bed modular reactor program as part of its new energy blueprint, which aims to get more than half of South Africa's electricity from clean energy sources by 2039. The 2.2 trillion rand Integrated Resource Plan 2025 has been approved by Cabinet but not yet published. Commenting on the blueprint, Minister of Electricity and Energy Kgosientsho Ramokgopa says IRP 2025 will see the majority of SA's electricity generated by nuclear and renewable sources such as wind and solar. The plan will be published in the Government Gazette by Friday. Further details of which nuclear power technologies SA will invest in and how they are to be financed will be set out in a new nuclear industrialization plan. Deputy Reserve Bank Governor Fundi Chazibana has issued a blunt rebuke to calls for green monetary policy. She argues that central banks that swap credibility for climate subsidies will do more harm than good. Her rejection of the idea comes as central banks from Washington to Frankfurt face growing calls from policy researchers and academics to go beyond their traditional inflation-fighting remit and take the fight against climate change directly into financial markets through their operational toolkit. The calls are especially loud in Africa, which faces unique headwinds in the climate transition. Spear has posted a 5% rise in half-year distributable income per share. That's as the Western Cape-focused Real Estate Investment Trust benefited from higher rental income, new assets and efficient cost control. An interim dividend of 41 cents per share has been declared. That's up 5.2% on the previous period's payout. Looking ahead, the firm has maintained its full-year guidance of growth in distributable income per share of between 4 and 6%. Coronation Fund Managers has flagged lower full-year profit, largely due to the absence of last year's once-off tax litigation benefit. The company expects its headline earnings per share to decline by up to 30%. It says the prior period's results were boosted by the reversal of a tax provision after the successful outcome of its long-running SARS dispute. Excluding that once-off impact, the group expects underlying operations to show improvement. Fund management earnings per share, which strip out the tax effect, are expected to rise between 5 and 15%. Coronation is set to open its books next month. Sirius has expanded its portfolio. The real estate owner will acquire a business park in Feldkirchen in Germany. The transaction carries a price tag of 43.7 million euros. The asset generates around 3.4 million euros in rent per year and is 94% occupied. Following this deal, Sirius will have acquired around 340 million euros worth of income-producing assets across the UK and Germany so far this year. Commenting on this, CEO Andrew Coombs noted that the group did inform the market that its acquisition program would be more weighted towards Germany in the last 6 months of its financial year, and this latest transaction underscores that sentiment. Fintech platform Optasia is getting ready to list on the JSE and has set its initial public offering price range of between 15.50 Rand and 19 Rand per share. The listing will include a primary issue of about 1.3 billion Rand to fuel growth and a secondary sale of at least 5 billion Rand by existing shareholders, making the total offering at around 6.3 billion Rand. The capital raise is intended to help Optasia scale its AI-enabled microfinancing and airtime credit operations across emerging markets. In international company news, Kering, the parent company of Gucci, is selling its beauty business to L'Oreal for $4.66 billion to reduce debt and focus on its core fashion business under new CEO Luca De Meo. Here's more detail in this package report.
Gucci owner Kering has agreed to sell its beauty business to L'Oreal for $4.6 billion. It's a major shift in strategy by new CEO Luca De Meo as he moves to tackle the luxury group's high debt and to refocus on its core fashion business. Under the deal, French beauty giant L'Oreal will acquire Kering's fragrance line Creed, as well as rights to develop fragrance and beauty products under Kering's fashion labels through a 50-year license. These include Gucci, Bottega Veneta and Balenciaga. The sale is a significant step towards reducing Kering's net debt. It stood at $11 billion at the end of June, on top of $7 billion in long-term lease liabilities, which concerned investors. It's also a major shift in direction by De Meo less than 2 months after taking charge. He's unwinding one of the biggest strategic pivots made by his predecessor, François-Henri Pinault, whose family controls the group. Kering set up its beauty business in 2023 after acquiring perfume maker Creed in an effort to diversify and reduce its reliance on its Gucci brand, which accounts for most of its profits. But the group has struggled to ramp up business, posting a $70 million operating loss for the first half of the year. The company's also battling declining growth at Gucci. It was hit hard by slowing demand in the key Chinese market.